Pickers Market episode 4.
What's up?
Take
Nice.
2. All right, and we have Mr. Keith Gangl back with us after the high demand from the last one. I feel like I should do an applause here, but that one goes on for a while.
Let's not.
But at the end of the last episode, we were talking about concerts and rock bands. I didn't do my homework. I looked up some of the rock bands, but I didn't know.
Brutal.
I didn't know one name on the list of up and coming rock bands. So
when I yell Freebird, do you even know what that means?
Yeah, I know Freebird.
Okay, gotcha. All right,
yeah,
good.
Well, the only reason I know it was a garage, the
Xbox,
like the garage band.
Ah, gotcha.
It was on
Okay,
that.
hey,
So-
that works.
so I know-
However
so I know
you know it, as long as you know
yeah.
it.
So that's why I know that one. But you went to Garth Brooks.
I did.
So I'm curious how that was.
Vegas, Garth Brooks, old is probably the way I would call it first. I was of the younger demographic there, which happens much more rarely these days. So it was an interesting concert. He doesn't jump and run around like he used to, but he still, he played for like 3 hours. And so you could see from his energy and also his audience's energy, it's just different energy than it used to be.
How old is he?
He's probably in his late 50s, early 60s at this point.
Late 50s, I think.
I mean, he was popular when I was in high school, and that was in the 92, 94 area, that kind of thing. So that's 30 years ago now.
Still got the vocals for 3 hours.
Yeah, he still cranked it out. Only took one real break when he brought Trisha Yearwood on, who's his wife, and she sang a couple of songs, and he took a break during that. But outside of that, he was going the whole time, and it was a blast of a show. Like the Vegas venue, I was at the Coliseum in Caesar's Palace. That place is awesome. Like
Nice.
that, it was a great place to catch a show. So had a really good time. It's the stadium versus that venue, and just the ability of the performer to go like he used to just isn't there anymore. But with that said, I mean, he can still crank out his tunes, and he played all his classics. So he doesn't do anything from quote unquote new album or anything like that. So it was fun. We knew every word to every song. It was great.
That's awesome.
Stay for the whole thing, or do you bail out early?
No,
Just making sure.
So they did 2. I'm not there yet. I'm not bailing early yet, Gangl. He did 2 encores. So a couple of people did leave after the first one. I felt a little bad for him, but he played Friends in Low Places the first encore, and I think that's what everybody was like, oh yeah, he's done. And then he came back out, did a couple more songs on the second one. So I stuck around for the whole thing.
Nice.
Gangl. I made
I
it.
like it.
Yeah,
You're in Vegas, living it big.
And then Minnesota sports.
Yeah.
Pretty much suck. But we actually have something to cheer about, right?
Not now, baby.
Right
We're
now.
living in the high times right now.
So Jeremy, being our resident basketball expert, I'm curious, can we keep this going?
Yes. Are we, now everybody's talking about a sweep. So for those of you who don't know, Minnesota Timberwolves are up 2-0 against Denver, which was very surprising because the first 2 games were in Denver, and Denver's the defending champion. So from our side here, I said this before, is that we have an identity now, which we've never had as Timberwolves outside of being terrible. That was our identity. For the longest time. Now we have an identity of a defense team. We're ranking much more quickly about how good are we compared to history, not even just against some of the things.
Come on.
Yeah, we'll see if it continues. The Minnesota fan, Gangl, you being the poster child of everything is going to fall apart eventually.
Don't worry, it will, unfortunately.
So we'll see what happens. But I think we need to throw a little cold water on the people that are just now like going from we're up 2-0 to we're a sweep and we're the championship favorite. I'm still not quite there yet as a Minnesota fan. I won't be there until they're actually hoisting the banner.
Yeah.
And even then I might be like, oh, that thing's falling down the Gangl style over here. But from that, we at least have a shot. We have as good a shot as anyone right now. And we haven't been able to say that since the KG era in 2004. So it's been 20 years before we've had this kind of shot. So I'm just enjoying it.
So super fan, you plan on going to any of the games, or?
I'm going to try to get to one. Yeah. So I was even thinking about, taking a field trip to Denver if it goes over there, and seeing them seeing them beat them on their court again, that'd be a fun. It'd be more fun to go to LA and watch them beat them on, like if the Lakers were in it and watch them beat them, that would be the most fun. But this still wouldn't be too bad. So thinking about it,
someone's getting a little bit over their skis, I think, unfortunately.
Yeah. Oh yeah, I guarantee. So I told you this yesterday, is that I'm getting to a level where it's not quite there yet. But for you probably remember this, but you were really, really young. Maybe, you were around barely. 98 Vikings,
barely,
of the the season where we looked invincible and missed the field goal at the one and should have just dominated through. We were easily the best team in the league that year. Now we're not easily the best team in the Timberwolves, but now I'm getting to that levels of if we screw this up, and especially this series where we're up 2-0 coming home, that level of disappointment will be pretty high.
Yeah. Although I have seen sportscasters are now comparing Anthony Edwards to Michael Jordan.
Yeah, they gotta calm down on that. Even Edwards said you gotta calm down on that. I haven't won anything yet.
So crazy.
22 though, he's for 22, he is playing out of his mind, which is so fun to watch because we haven't had somebody like this since KG era.
Garnett. That was back when I was used to watch basketball. It's been a long time, so maybe I've watched a quarter or two now, so at least I know who the players are.
Don't jinx us, gang.
I'm not getting on board. Don't worry, I won't. They get in the championship. Maybe I'll
you turn the TV on, and all of a sudden we just go straight south.
It certainly could happen.
All right. Well, my hot button for this week, switching gears here real quick. Kind of a play on words. Last week we kind of talked about the quote, "Sell and May, go away."
Yeah.
So the other one that we hear a lot
quick
about
recap of that. Don't do it.
Yeah. Don't. But another one that you hear about a lot is green shoots, right? The economy has green shoots, or this sector has green shoots, right?
Yeah.
Whatever that freaking means. But we've started hearing it quite a bit with M&A and IPO activity. We've heard it on Morgan Stanley's conference call for their quarter. They've started talking about it. Wells Fargo has started talking about it on their conference calls. So I'm curious, do you think the current environment is conducive to the quote unquote green shoots for M&A or IPOs?
Yeah, I do. I think we're starting to see some signs of it, especially on the IPO side of things, that they're starting to come to the market now when last few IPOs that came been fairly successful. So that when you start seeing that as a company that's kind of in the queue, you're like, oh, maybe we'll start to see it. But I do think it's going to be more fits and starts. It won't be with interest rates as high as they are right now. The economy's it's very solid, but it's not like roaring along either. So I think the area we could potentially start seeing is with AI, artificial intelligence. Okay. We'll start seeing a lot of the big companies are there, right? NVIDIA and Microsoft and Google and Meta. But I think you'll start to see some smaller plays, companies that can try to capture that momentum and go to the market quickly. So we'll see. But I mean, interest rates up right now, so I think it's going to be fits and starts. How about you, Jeremy?
Yeah. I mean, green shoots are only a result of something being horrible, right? For a long time, because you got to look for positivity somewhere, and that's where when they say green shoots is, oh, it's been bad for so long that hey, it's starting to look decent, and interest rates is the cause of that, right? Yeah. I mean, when you go from basically free money to money that costs a lot in order to do a deal, you're just going to stop doing deals, right? It just changes the economics of them. So that as people get more used to, or if rates come down, or if people just get more used to it. Similar to kind of the housing environment, right? It stinks when you go from 2% to 6-7% plus in a mortgage, but people get used to it. And I think M&A has to get used to it too. And there has to be a catalyst for it. And I think AI is the catalyst for certain. I mean, this is a weird structure right now in AI in the effect of that the incumbents are probably considered the big winners here, where, if you consider AI the next internet, if you will, I mean, internet looked at, these were all new companies that were coming out and all this stuff. Yeah. And I think that's probably where we get to eventually, is that there's going to be new companies that bring different technologies that are outside of the current sphere of the incumbents right now. And that's when M&A will really kick off, is somebody figures out a revenue model of AI that's different from what's out there right now. That becomes replicated amongst other companies, and then Goldman Sachs and Morgan Stanley just start throwing those out there. Sure. I don't think we're there yet, but I think that's probably your biggest catalyst for a massive swing of M&A and IPO activity.
Do you think it'll be a big, like as soon as one small AI company IPOs, do you think there'll be a massive rush, or do you think it'll just kind of be someone finds something different and it'll be kind of these one-off things for the AI companies?
I don't see a massive run, just because I think for AI to work, you got to have scale in the data, and that's good or bad, the large cap guys own that,
Yeah.
right? It's, Nvidia's the chipset guys is, leading the way, but then you have the people like Microsoft and Google and Meta, the ones that actually control the data and seeing all the data. They're the front row of, the AI situations. But like Jeremy said, you'll find some technology or some spin on that. I think you'll see some, but I don't think it's going to be like the past where you saw software, the coming of the internet, where you saw pets.com, all these different, one-offs, and all of a sudden everybody just roaring like that. I don't see it, back to like
do you think
2000.
it'll be more private equity type stuff and we won't really see it come to market or come to the public market, I should say?
Yeah, I think there'll be a lot of different plays, but they're going to be more niche. There's not going to be like one home run play unless you see something that just totally changes the dynamic that we're not thinking about right now. That could be the catalyst that all of a sudden a bunch of players like, oh, I can capture that as well.
Yeah.
Whereas away from the big guys right now, but I don't see that yet. But again, I don't see it doesn't mean it's not going to happen, right? Because as soon as one happens, all of a sudden everybody gets excited about it. Then anybody that can build a technology similar to that will try to come public.
Do it fast. Yeah. From my side, the other side of that is just think about, Microsoft, Meta, Google. These companies are putting if you look at the CapEx of their businesses, they are just absolutely skyrocketing CapEx right now because they're putting every dime into this. And so there's, as a result of that, and them kind of seeing their own destruction to a certain extent and trying to prevent that as much as they can. I think that's the lesson they've probably learned from the last go around of a new technology wave is like, hey, we have to spend in this thing. We can't just kind of protect what we have. We have to, even if we kill ourselves a little bit, we have to to build the next thing. We're seeing more of that. And so that just leaves less room for some of these other things. Like private equity will be involved in those kinds of things. But if you remember, like Google and Meta, when they came out, they were pretty established at that point. So I don't think you need to have all these, hundreds and thousands of companies coming out that don't really have a revenue model. I think what you'll see is private equity and venture capital going into a ton of them. And then you'll see a couple of them grow up. And those will be the companies that go out, and they'll be instantly big because they're already proven in the private markets.
Got it. All right, cool. Well, that kind of brings me to my next point. And so for those of you that don't know, Keith Gangl is a 2-time Lipper Award winner.
Gangl!
Wow.
And also he is a 2-time now Gradient Cup.
Oh, that's probably even more important than the Lipper Award.
Two-timer.
So Lipper Award winner is one of the highest award you can basically get in the mutual fund landscape. You're the best manager of your group out of 600, 700 different managers. You have the best performance, right? So I'm curious, what goes into, and this is kind of our nerding out segment, so you can kind of go into it a little bit deeper if you want. But what do you look at for a stock? And Jeremy, I'll let you answer too, but I'm just kind of curious. Like what drives your thought process on I'm going to buy this stock for my portfolio?
Yeah. So I look at a couple different things when I'm investing. I look at company fundamentals. How's the company business doing? What's their market opportunity? Are they growing? Their revenue, their margins? That's kind of my core, tenet right there. When I'm looking for a company, I always analyze that. Then you have to mix that with macro, environment. Like, if for instance, interest rates are high or low, how is that going to impact the overall company you're thinking about investing in? So first of all, it's the company level, it's the fundamentals, then it's macro. Another tool I use is technical analysis. I know you and I have talked about that a little bit in the past. I use that more for timing. Once a week, I like to at least try and flip through. It used to in the old days, it was a paper book. It would literally, I'm dating myself now. It would get delivered on Sunday night. It would have
the Investor Business Daily.
Yeah, it was William O'Neill's chart book. So it was delivered on Sunday night. So Sunday night, literally while I was watching football or whatever, I would flip through the chart and it would have 1,000 different stocks, and it basically all is this technical analysis. It just shows you price patterns and volume. And by looking at that, these companies, I would analyze, just quickly flipping through the chart, say what came up interesting that I wasn't looking at. Maybe also stocks in the industrial space started to look interesting. The stocks I didn't own, fundamentally, I looked at them, but I wasn't that interested in macros, wasn't that, need to own them. But also there's a pattern that I liked. I'm like, oh, that's interesting. And then I would go back and look at the fundamentals and check out the, how's their market opportunity? Is management team executing? Are the margins going up? Are they accelerating their growth drivers? Is their revenue increasing? Why is it increasing? Are they, who's their competitors? Is their whole space doing that, or is it just them? So those are some of the tools I used to get into it. But technical analysis I use for timing, just try to what's a good timely idea, maybe things I'm not looking at. And same thing when, things maybe are starting to roll over, that's why I use technical analysis. It's nice to kind of look outside the box. But really what's driving my, investment decisions is fundamental analysis, looking at perfect example we just talked about a little bit is artificial intelligence. NVIDIA, owned the name for a long time, love it. I mean, they're in the catbird seat right now. They are the semiconductor chip that makes artificial, intelligence possible. Their speed of the chips is far above and beyond everybody else. This was even before AI became, a big talking point. They were the fastest chipset. We liked it. We owned it. Fundamentals, they were growing, at 20, 30% a year. Valuation wasn't cheap. We didn't talk about valuation. That's another thing to always consider is what do you want to pay for a stock? Mm-hmm. So sometimes you pay a lot more, but if it's a growth name, they can grow into valuation. And sure enough, with NVIDIA, they've actually grown over 100% in their revenue. That's a pretty impressive when you're talking billions of dollars that they increase, but that's due to the CapEx that, Jeremy just mentioned, Google, Meta, Microsoft, they're throwing billions of dollars. I think now Meta's CapEx for the next year is almost back to $100 billion to Jeremy's point. They're creating such a big moat for them and their competitors. And that's why, and who's going to benefit from that? That's NVIDIA. That's why we own it. And you look at the TAM, at some point in time, valuation becomes stretched and we need to reevaluate and, pull it down, or the growth rate's no longer going to be 100%. So that's some of the things we consider when we're actually looking at buying a stock.
In the growth space, is the story more important sometimes than the actual fundamentals? Yeah,
it certainly can be. Like in growth themes, like cybersecurity is one space I generally like. I'd like to do theme investing as well. You touched on it a little bit. If I like the space and fundamentals are going in the right direction, you're accelerating your growth rate. Your valuations may not seem very, very cheap. I mean, they're probably on the other end of the stream. They're expensive, right? And Jeremy would shake his head. He's a little bit more of a value guy than I. So I will take, kind of plug my nose and buy those things, knowing the theme that, cybersecurity, there's a big wave coming or whatever the theme is, and kind of plug my nose on valuation. But as long as numbers are going up, stocks can appreciate. But on the downside is when the numbers stop or slow down, when they're not growing at 30% that they were growing, and all of a sudden it just tips down to 25, that's generally a sign you should get out because the stocks are expensive. Value, growth rates are slowing. Yeah. Generally, people can flock from those high growth things pretty quickly, and they can be pretty painful owning on the downside, which I've done as well. So it's try to avoid those situations.
So the other thing that most of you may not know is that Keith sits directly behind Jeremy, and then I'm directly in front of Jeremy. And so basically all day, all I hear about is these two bickering about what stocks they like and don't like. So I kind of want a little bit of a rebuttal on Jeremy. Yeah, he's more on the values. I don't know if I would call you, I would call you a value investor, but right. you manage value portfolios. So I'm curious. Yeah, it's maybe a different way you look at companies than Keith.
Yeah, valuation is more important to me. I mean, that's probably our biggest difference. And it's also because of the space, right? Because of the space we're in different areas. And if you're buying pure growth models, valuation is probably not going to tell you a whole heck of a lot. But if you're in more stable, long-term kind of companies, your Walmarts of the world and those kinds of things, valuation, you can almost use that as a timing metric, right? Because they've been established for such a long period of time. You get a real good sense of when it's cheap and when it's expensive, both compared to itself and compared to the market. And so from my side, that's what I pay a lot of attention to is where is this thing trading compared to its own history and where is it trading compared to the market in general? So that's what I try to pick and choose because these businesses that I'm talking about, those kind of Walmart, Costco, these kinds of things, they don't change that much, right? I mean, they're not in cybersecurity, right? I mean, the inflection points don't change. Their business models don't change. I mean, the market caps can change much faster than the businesses do, right? I mean, they're kind of who they are. And so if you can find them when the market, deems them somewhat out of favor in the short term, you can usually make a little bit more money long term. Because I do believe in a lot of regression to the mean, right? In that area is that usually over time, if a business executes and they're not changing a lot of their model, they'll probably get back to that long-term average valuation. And so when you can buy them on the cheap and sell them on the expensive, you're probably going to do okay. The one that I absolutely agree with Gangl on that I just want to expand on a little bit is the expectations game, right? That's really from a price inflection standpoint about working and not working. Mm-hmm. You always got to know what the expectations are and are they beating or missing those? Because that's the biggest thing to me of, is this stock going to regress back upwards? It has to have a change in attitude, right? People have to buy it for some particular reason that's changing the course. And so if it's not beating or meeting those expectations, at least meeting and hopefully beating them, then you're caught in what I call a value trap. And, you mentioned your growth names that turn over. I think that's where I get hit the most, right? Is I'm buying things on the cheap, thinking that those will regress or, revert back to the mean, but something has changed in their business or they're just going through a bad cycle and it just gets cheaper and cheaper and cheaper. Sure. That's where I can get hit. And that's where, I feel the pain of your growth names is mine tend to be much more of a slow bleed. And they always look cheap, right? It's like, well, do I sell it now? It's even cheaper than it was before. And you just watch yourself bleed out. So that's what I have to be careful of. He has to be careful of much more of that. Growth just kind of inflected and went away, and the stock just pummels as a result of it.
Yeah, to that point, I mean, an expensive stock can always get more expensive, and a cheap stock can always get cheaper, right? It's just something that happens, and just because it's one valuation or another doesn't mean it has to go one way.
Yeah.
So,
and there's certain stocks that one of the portfolios I manage is the core select, which looks like the S&P. So I have some of these more core names and value names that Jeremy and I overlap on a lot of different names that we like the same things, the same trends and the fundamentals and that.
I think you and I agree a lot on fundamentals.
Yep.
We like kind of the same businesses. Like these guys have a moat. They're doing what they do. I think we always laugh at each other because I can always be like, oh, here's Gangl, here's a chart you like. And I'll be like, hey, take a look at this one. And he'll do the same thing for me. It's like, oh yeah, here's something that's gotten on the cheap. You might want to take a look at it. So we know each other's patterns a little bit, even though we don't always agree on the things we would buy. We know each other's patterns enough now to know where the other one, this is something interesting for them. So it's nice to be able to bandy that about too.
Yeah. So talking about names that you guys may or may not like, Berkshire Hathaway. This was my thing you may not know about. And, they just had their big annual meeting last week. Obviously, Charlie Munger passed away last November. But what astonished me was their amount of cash they have on their balance sheet. Do you guys know how much they had at the end of the last quarter?
It was almost a couple $100 billion, right?
$189 billion.
Yeah, I was going to say, no, it's over 100. Yeah.
So that means that they could effectively buy Ford and GM, both of them, and still have cash left over. I think they would still have about $50 billion left over in cash.
Pretty
solid. Or they could almost buy all of McDonald's. I think it's like $6 billion off of buying all of McDonald's.
I'm sure he could loan a little bit to swallow that up if you wanted
that, or maybe the stock will go down one day. They can.
Yeah, exactly. Yeah.
So I'm curious, is that something that is of value when you guys are looking at the companies, or is that something that kind of takes away because it's just sitting in cash? Granted, call it 5% on the 189 billion is about, call it 9-ish billion a year.
Yeah.
In just interest if they had it all invested. But when you're looking at a company like Berkshire and somebody has that much cash,
for me, just on the from the growth angle, I'm putting my growth hat manager. Cash doesn't do a whole lot for you. You'd rather have them investing into new growth ideas or new technologies or trying to expand their overall market. So you don't necessarily need that cash level. Now, when you get to an economic downturn, if, obviously the big guys, Apple, they got a big cash balance sheet as well. They used to have bigger. Now I think they're paying a nice dividend, stuff like that. They're giving shareholders money back. But I still think their balance is, I think, almost close to 100 billion as well. So there's plenty of cash there. But generally speaking, from growth, I'd rather see them buying, either go buy a new business, go buy a new product line, investing in your company yourself, investing in your employees to develop the new product or whatever to expand their total addressable market. That's where I like to see the cash levels. Jeremy, you're probably a little different on your side of things.
Yeah, I would say yes, because in my opinion, cash provides them optionality, right? And it also provides a safety net. If you're, and not even just having a pile of cash, like having a pile of cash on your balance sheet, cool. But your ability to generate cash, even if things take a downturn, your ability to continue to generate cash, much more important to me, because it allows you to do exactly what Gangl said, is that, if you find an opportunity, you can take advantage of that.
Yeah.
Secondarily, if you're generating a bunch of cash, it allows you to build your business without having to worry about any external financing and those kinds of things. And so, frankly, a lot of the technology businesses have morphed their way, the large ones, into being those types of businesses. Those have massive cash balances. They generate a ton of cash going forward. They can self-fund. That's why interest rates we never understood why interest rates were so big to these big technology companies. They can self-fund themselves 3 times over. It does not matter from their particular point of view what interest rates are. It actually helps them because they have cash balances, and then all of a sudden, they get a little windfall from that. So from my side, I like companies that generate a ton of cash, whether they have that or, whether they have that kind of treasure trove on the side is less important to me, but I want them to be able to not only meet or exceed what they've currently listed, but have some optionality in doing things in the future. Because again, at some point you have to reinvest in your business. And honestly, you have to continually do that. So the ability to generate cash to then deploy it in the proper manner is really important to me.
Yeah. Well, I think also, prior to the current interest rate environment, a big cash pile was just an anchor for you because you were getting nothing, right? Whereas now, if you have a little bit of cash, you're at least getting something for it, or the company's getting something for it that they can then use to fund some of their operations.
Yeah, I don't think Warren would have cared though. I honestly, they had a big cash balance even when it was zero.
That's what I was just going to say.
Because he's a different beast. Because he's going to go. What he would say is, I use this for when everyone else starts panicking. And that's a great method and approach if you can do it, if you can get away with it. Problem is he's a little different, and his investors give him some leeway maybe that some other companies don't get. And so he would say, even if I don't get one dime from this thing, it allows me to do what I want to do when everyone else has to go self-finance or just can't meet what they need. I can go buy that on the cheap.
Yeah, that's exactly what he did in the great financial crisis, right? He had so much cash that the government was actually turning to him to fund some different things. And he had some, this was 9-10% coupon levels. He's getting on
A-list companies.
On A-list companies where everybody else was getting 2 or 3%. So he's getting 5x the return. But he has a lot of cash. I think he's whale hunting. He's looking for the next Burlington Northern. And in reality, with the way the market's moved and the valuation is, I think a sign that he's got so much cash in the balance sheet, he thinks the market's just fairly valued. There's no really screaming deals. That's why he's looking for that screaming deal, that kind of panic situation. And it's not the case. And he doesn't mind just holding cash.
No, he'll hold it all day until he finds something that he wants to buy.
So I don't know how accurate this is, but this is from Macro Trends. It's a chart of the historical cash balances, cash on hand for Berkshire Hathaway, and says at the end of 23 they had 38 billion.
Okay,
but now they have 189.
That's a lot of cash.
We'd have to look into that.
Yeah, I'd have to figure that out. But
possible, but that would suggest to me that he sold something, and I haven't heard anything of it outside of he's reduced his Apple position and things like that. But not to that extent.
That was the other thing. He reduced Apple from a 50% position in his portfolio. I think he reduced it by 15%,
something like that. Yeah,
like that.
It's still a lot.
It's still a lot. It's a lot.
Own 5% of a $2 trillion company.
Yeah,
own 5% of it. Cool. All right. Well, that's good. So I guess let's move on. The other one topic, and Jeremy, this one might be more for you since you've done a little bit more international because Keith's more of his home bias.
I'm a home bias. Go US.
But this was my wait what. So one of our analysts sent me a chart the other day, and it's split up European stock, specifically European stocks. Usually you look at like developed markets or kind of slice and dice them, but it was Europe, the Euro Stock Exchange from 1990 to 2010. And it actually outperformed US from 1990 to 2010. I did not realize that.
Yeah, so 2010 is, 2009. We had the lost decade in 2009. So, yeah.
So US was up roughly 250% during that time. Europe was up 300%. Since then, Europe is up 200% from 2010 to now, and the US is up 575%.
Yeah.
So, and it was more than 1990 to 2010 that kind of caught my attention, just because I didn't realize it was that close.
Yep.
And I know these things go in waves, and they're kind of glacial in pace when they do happen, when Europe or international developed outperforms the US and vice versa. Because there are times when international developed has outperformed the US, obviously.
Yes, people, it has happened in the past.
It has
been a while, but it has.
So I'm curious what that shift was. Like what has caused, in your opinion, and Keith, you can chime in on this too. I know you're not a big international junkie, but what was the big transition period from 2010 that caused this transition in performance?
To be honest with you, in my opinion, the by far the biggest thing is the composition, right? Is that we have the best technology companies in the world. That really kind of says the whole thing. Is the companies that have grown since post-financial crisis, the companies that have exploded are all in technology and communication kind of things, right? Sure. Your Amazons of the world, your Netflixes, your Apple's, your Microsofts. Microsoft reinvented the wrong word, but kind of re-engineered their growth again, because they were considered probably not a dying firm, but certainly
slow growth.
I mean, it was 12 times earnings, and in as late as 2010, 2011, that's considered kind of much more of a mature kind of company, and they've just been able to re-engineer and refocus their business. But I think that's the biggest difference, is if you look at the composition of international versus US, the biggest difference is we are heavily weighted towards technology names, technology and services and all that stuff. But the names you think of when you think technology. International markets, especially Europe markets, are still very heavily financially oriented, which, they have fits and starts, are much more cyclical in general. Old scale industrial type of names. And then, after that, it kind of falls off. But if you look at technology, I mean, what's the best? ASML is probably the best international technology or, European technology company out there.
SAP in there.
Yeah, you could if you really want to stretch. I would say that they've probably been a share loser, or maybe they would disagree with me, but I would think that they were much more established probably pre-2010 than post-2010 about how big they are and how important they are. So they really just lost that battle over there, and I think that is the primary difference of that. So if you're going to ask me going forward, again, that's what they need to figure out. I don't know what their solution is for that, because again, we were talking about moats and all the other stuff. Is like Europe, the European business centric community just does not seem to be technology oriented, right? Every investment dollar comes this way for that, or honestly goes to Asia for that in some ways. Usually it splits the two, much more to here lately, but from that side, it's just passed them by. And so they have they still have good companies, don't get me wrong, but from what the growth and what people have been attracted to post financial crisis, they just didn't have the positioning.
Yeah, I think the other thing to layer on that is regulation. I think they're a little more heavier regulated. So I think that kind of dampens this kind of innovation I think we're talking about too. So I think that kind of goes hand in hand with there's no reason that they can't have tech growth companies, right? There's no reason they couldn't have an Apple or Microsoft or something like that develop over in Europe. They just don't, I think, because innovation comes here. I think California has certainly been a hub of innovation, right? All the best and brightest go out there and develop these technologies that people want and use that are globally used. Silicon Valley, right? And so that's kind of where people are going to. But now that's even starting to spread across the U.S. It's not just Silicon Valley, right? There's other hotbeds all over the place. You got Nashville and different places like that, Austin, Texas, where those are becoming hotbeds of technology. And
for sure.
And those are the people where the best and brightest go there and they work and develop these companies. And there's, again, a little less regulation. I think those companies are known for growth. They provide a lot of upside for people that in monetary base too, right? I mean, they're paying these employees a lot and they're developing a lot of things. So I think that's where the U.S. has that advantage over Europe. Yeah. But there's no fundamental reason. Like, is there any reason that they should be?
Well,
that
just
they could do the same thing.
What you said with regulation, because when you say regulation, my head always goes to financials, right? Because they're the most heavily regulated in the world, especially since they almost blew up the economy in 2008. And just think about the composition there, is they're much more weighted towards financials. So if regulation's a problem and that's the epicenter of regulation tends to be financials, probably going to hurt them more than it's going to hurt us. So all of these little things together have caused this differential. I mean, 200% performance isn't terrible, but if you look at, on a annualized growth basis, it hasn't been a disaster. It's just been a relative underperformer to the names and the companies that have become so big here that Europe just missed out on. And I don't have now I am not a historian. I don't know the reason for that. Like, why couldn't we develop something that, in the same realm? You might be right that it's regulation, but the fact is they just haven't. And they need to figure that out, because we're also, as a result of that, growing faster than they are, because of the engines that we have as companies here, and because we allow our consumers to then spend more because we're getting richer and those kinds of things. It rolls right back into the economy. So it's kind of that feedback loop, right? Is that we have the best companies, so then we generally, our economic conditions are a little bit better too. And that just continues to accelerate that differential. I don't know what changes it over. I just know that history usually tells you that something does.
Yeah. Right. Yeah. They're also known for their engineering in Europe, right? So Tyler, you're switching gears a little bit for you. You're a big F1 guy, right? So it's like, why? That's big over there, not here, right? It's a certain, that's kind of, you want to walk, is that kind of play into how the US versus Europe and kind of some of the differences there?
I don't know if I would say that it's much of a difference. I just think like NASCAR's big here, right? It's just a different kind of sport. And I think like the car companies that are competing in it are all European based too, usually, outside of a few, but like your Mercedes, your Aston Martins, right? McLaren, I guess you could argue, is US, but they have their plant is over in Europe. So, I just think there's not much of a similarity, but I think it's getting bigger here.
So isn't it interesting to you guys though that German engineers?
That's
right?
What I'm saying. That's why.
What's the biggest EV company in the world, right? You would think they would have owned that market, and then Tesla basically took that over, right? If Germany has all the best engineers and they have the best auto, why didn't they take that market? And again, maybe it's just an innovation thing. Maybe it's just a culture difference in having that kind of thing and not wanting to kill what you currently have. And Tesla didn't have that, and so they were able to innovate around it. But that's interesting to me too. It's like, you would think Mercedes, BMW, and Audi would just have owned that space, that's right? And it just didn't happen.
Yeah. All right, my last one, because we got to wrap up on time here, but spaghetti wall and older versus younger. So when I was in college, ebooks started to become a pretty significant part of what you would buy. And so I'm curious, do you guys use ebooks, or are you guys still 100% paperback?
I'm probably 98% paperback. There's once in a while I'll read. It's a quick read though. It's not. I just. It's on an iPad too. I'm getting older. My glasses. So it's that's the one nice thing about reading on an iPad, right? You can enlarge the verbiage. So that
Gangl's got one word per screen.
No, not that bad. No, my just barely magnifying 125. So not terrible.
Well, that's 25%, Gangle.
Well, I see some people. Well, I don't think that's 25%. You see some people running around with these 200 glasses, 250. So
100 to 125.
That's 25%, but I don't think that's
it's math.
The most math guy.
Right. Exactly.
Is saying it's not 25%.
To me, it doesn't seem like it's enlarging it by 25%. How does that sound?
Because I think your ego doesn't want it to be 25%.
Wait, I put on glasses that are 200. It doesn't seem like the words are 2 times as big. That's my point relative to that number. But no, so I am paperback. So
yeah, for me, it's a hybrid. I'm a hybrid.
Are you Kindle?
Yeah. So even so I'll give you a little shout out to my wife. She is much more the reader than me in my family. She has even pivoted towards, she's probably still 80-20 paperback, and she used to be 100-0 and was like, I hate Kindle. It's not. She would even say it's not reading. I don't know where that definition came from. But from my side, it was, if I'm traveling and I want to read a book, I bring the Kindle for that. If it's something that, I'll maybe go back to, I'll definitely do a paperback. Or usually what I'll end up doing is, if something I want to retain a little bit more, frankly, I use paper for that. If it's just something that's just kind of mindless reading that that's a good Kindle one for me. So I tend to be hybrid. I am absolutely somewhat agnostic on it, but that's kind of how my mental focus works with regard to that. Is I feel like I'm sharper and I retain more when I have it physically. I feel like when I have it digitally, it's just kind of more okay. It's just
just
like other
swipe,
articles
yeah.
that I'm reading that I'm just kind of swiping through.
Yeah. See, for like CFA stuff that I did, the option was either basically you get a free ebook or you had to pay extra for the paperback.
Okay.
Mhm.
And I was like, I have to pay extra for the paperback because I'm not going to retain one thing if I read it on the ebook.
Yeah.
So I still haven't gotten a Kindle yet.
No,
Oh, really?
I'm still 100% paperback.
Wow. Older versus younger's flipping on us.
Well,
it is.
interesting note. So I got, a couple girls in college and son in high school, but I just moved my one daughter home this last weekend, whatever, or at least went to her dorm, and books all over the place. So they still have books. So I asked her, but her study habits, she'll show me pictures that they're definitely using iPads and, not Kindles, but iPads for their lectures and notes like that. So it's definitely split half and half. I thought it would certainly be a lot more just technology based and no books.
I did too, actually.
No, so it surprised me. And she's got to sell back books actually at the end of the year too. So it's like, and you buy them for $200, you get $2 back at the end of the year for your paperback. So there's some resale value in them.
That might be the bigger, older, younger is the use of paper for doing things, right? Gangl, you and I make fun of Gangl all the time. He's got notepads of things that are on there, stock lists, whatever you want to, it's just filled with notes and all that and on physical paper. Whereas you barely, I don't think there's a sheet on your desk at all. And I'm kind of in the middle. I'll use it for a quick scratch, but I don't have nearly the volumes of things that he has on there. So I'm wondering if that's where the older younger is that the younger generation has no interest for paper for what they do. They'll read on it, but if they're doing anything, it's digitally done.
I mean, even for like grocery lists at our house, we put it all onto our phone and then order it from Target that way.
Okay.
Like we literally, like growing up, my parents would always write it out on the list, right?
That's how we're rolling.
Up in the fridge, something goes out, you write on the list, right? You're still doing that?
And my wife does it, and then she when I my favorite place to stop on the way home is Costco. She'll like, oh, send me the list or whatever, and she'll just snap a photo of what she has on there instead of, it's not like it's listed item by
now. Does
item.
she put the hot dog on there that you get every time, or does she...
no?
Hot dog
reminder.
Hot dogs. Bullet point one.
No, that's a guarantee.
Yeah.
That's a guarantee. She knows that she doesn't have to have that list. That's
gotcha. That's just automatic.
Yeah. $1.50. How can you beat the value?
That's pretty solid. It is pretty solid.
Oh man. All right. Well, with that, Keith, thanks for coming on again.
Thanks for having me.
And that was episode 4. And I think we might try to fit in a new guest for next week.
I think so.
So until then, have a good week.